Welcome to this special episode focused on the U.S. stock market. Before we begin, it's important to clarify that all the information and opinions shared in this podcast are for educational and informational purposes only. They do not constitute investment advice. You should always conduct your own research and make financial decisions based on your personal financial situation, risk tolerance, and future expectations. This episode is particularly important for investors who have not yet experienced a real market correction or a bear market. Market declines are a natural part of the stock market cycle, and understanding the psychological aspect of these phases is essential. Historically, the U.S. stock market has gone through multiple significant corrections. After the 2020 COVID crash, the market recovered strongly, but volatility did not disappear. In 2022, the Nasdaq experienced a major drawdown, falling approximately 37% from peak to bottom. That decline caused fear among many investors, yet it was a reminder that corrections are normal and recurring events in the market. In 2023, the market went through another correction, this time milder, with the Nasdaq declining around 11% from its peak. This period coincided with high oil prices and rising inflation, which pressured technology stocks and weighed on overall market sentiment. Another notable decline occurred in 2025 following the implementation of new tariffs under the Trump administration. From peak to bottom, the Nasdaq dropped roughly 26%. Despite the negative headlines, this type of decline fit within historical expectations for market corrections. At present, the market has declined about 6% from its most recent peak. Compared to previous drawdowns of 37% and 26%, this remains relatively modest. Larger corrections are always possible, and preparation is key. Preparation does not mean panic selling. It means having a clear structure and discipline. A resilient investment approach prioritizes broad market exposure through ETFs as the foundation of a portfolio. Large capitalization companies come next, as they tend to provide stability during volatile periods. These include companies such as Microsoft, Amazon, Meta, and Google. Historically, large caps play a critical role in protecting portfolios during market stress. Beyond large caps, certain thematic areas can be considered, such as cybersecurity and AI infrastructure. Software stocks, however, have recently faced significant pressure and may warrant caution. Small cap stocks should generally represent a smaller portion of a portfolio, as they tend to be more volatile and offer less downside protection during market downturns. Volatility is a normal feature of equity markets. Meta, for example, previously declined by more than 70% before recovering and eventually rising approximately 700% from its lows. AMD experienced declines of around 40 to 50% before later delivering gains of roughly 100%. These movements highlight how sharp drawdowns can coexist with strong long-term recoveries. Stocks are typically sold for a limited number of reasons. One is when company fundamentals deteriorate. Another is opportunity cost, where capital can be allocated to more attractive opportunities. A third reason may involve holding positions that become stagnant for extended periods, sometimes referred to as dead money, where the stock fails to perform despite the company remaining operational. Pharmaceutical companies provide clear examples of this dynamic. Novo Nordisk, for instance, issued guidance for 2026 indicating a decline in both revenue and profits. This followed political pressure to reduce weight loss drug prices by approximately 80%, which directly affected future projections. Similarly, Pfizer experienced a major surge during 2020, 2021, and 2022 due to COVID vaccine revenues. After reaching a peak price of 61, the stock declined to around 21, representing a drop of roughly 65% as COVID-related revenues faded. The stock later stabilized as negative growth moderated, but the example illustrates how revenue concentration can impact long-term stock performance. Overall, portfolio strength is primarily driven by ETFs and large capitalization stocks, not small caps. This structure is what helps portfolios endure periods of uncertainty. Markets will always go through phases of fear, negativity, and volatility. Investors must be prepared both psychologically and financially. Emotional reactions during downturns often lead to poor decisions and long-term regret. If you want to stay updated on the U.S. stock market, market cycles, and in-depth analysis, make sure to subscribe to the channel so you don't miss any future updates.